Good morning and welcome. If you've been following the headlines, you know the news is out. The Federal Reserve has finally begun its long-anticipated rate-cutting cycle. Financial news channels are buzzing, and my inbox is flooded with one pressing question from potential homebuyers and investors alike. Is this it? Is this the green light to finally buy that home? My name is your name, and as a seasoned market analyst specializing in the U.S. real estate sector, I'm here to cut through the noise and give you the data-driven truth. The headlines promise a new dawn for affordability, but the real question we need to be asking is far more nuanced. What does this move actually mean for your bottom line? In this video, we're going beyond the sensationalism. We're going to analyze the tangible impact. We will break down exactly how much a 0.25% cut translates to your potential monthly mortgage payment using the latest data from the FHFA on median home prices. We'll examine whether this is enough to unleash the pin-up demand we've been tracking through Redfin's market velocity reports, or if it's merely a psychological boost in a market still defined by high prices and incredibly tight supply. This isn't about speculation, it's about calculation. So, if you're ready to understand the real-world implications of this historic pivot and what it truly means for your real estate goals in 2024, let's dive in. To truly grasp the impact of the Fed's decision, we must first demystify a process that is often misunderstood. A common assumption is that the Federal Reserve directly controls mortgage rates, and that a rate cut automatically translates into an equivalent, immediate drop for homebuyers. The reality, however, is a more complex and indirect chain reaction that works through financial markets. The journey begins with the Federal Open Market Committee, FOMC. Their primary tool is the federal funds rate, which is the interest rate banks charge each other for short-term overnight loans. By raising or lowering this benchmark, the Fed makes borrowing money for banks more expensive or cheaper. Their goal is to either cool down or stimulate the broader economy by influencing spending and investment behavior. This recent decision to cut the federal funds rate is a signal that they are shifting towards a more stimulative policy. However, the crucial point is that this rate does not directly dictate your 30-year mortgage rate. Instead, it sets off a ripple effect. The Fed's action sends a powerful message to investors about the future direction of the economy. In response, investors often flock to long-term government debt, specifically the 10-year U.S. Treasury bond. Increased demand for these bonds drives their price up, which in turn causes their yield, the effective interest rate they pay, to move in the opposite direction, down. This is the most critical link in the chain. The 10-year Treasury yield is the foundational benchmark that lenders use to price 30-year fixed-rate mortgages. Lenders essentially take this risk-free government rate and add a premium to account for their costs, profit, and the long-term risk of lending to a homeowner. Therefore, when the Treasury yield falls, mortgage rates almost always follow. It's a relationship built on market dynamics, not a direct order from the Fed. But this relationship is not a perfect, mechanical one-for-one transfer. The size of the drop in mortgage rates can be more or less than the Fed's initial cut. The final number is also influenced by other factors, including investor expectations for future inflation, the overall health of the economy, and global market conditions. The Fed's cut is a powerful nudge that sets the direction, but the market ultimately determines the final speed and distance. This intricate dance between policy and market reaction leads us to the essential, practical question. After all this financial maneuvering, what does this nudge actually mean for your monthly budget? Now that we understand the transmission mechanism from the Fed to the mortgage market, we arrive at the heart of the matter, quantifying the actual impact. Let's move beyond theory and into practical calculation. For this, we turn to the most recent data from authoritative sources to paint a clear picture of what this rate cut means for a typical buyer. According to the latest weekly survey from Freddie Mac, the average rate on a 30-year fixed-rate mortgage had been holding steady at approximately 7.02% prior to the Fed's announcement. In the days following the cut, we've observed a measurable but modest decline, with the average rate drifting down to around 6.78%. This 24 basis point move is a classic market response to the Fed's signal. To understand what this shift means, we need a representative home price. Data from the Federal Housing Finance Agency, FHFA, indicates the most recent national median home price sits near $420,000. Assuming a buyer makes a 20% down payment, $84,000, they would be seeking a loan principal of $336,000. Using a standard mortgage calculator, we can see the direct effect on a monthly payment. At 7.02%, the monthly principal and interest payment would be $2,238. At 6.78%, the monthly payment falls to $2,186. This results in a monthly saving of $52. Over the course of a full year, this adds up to $624 in reduced interest expenses. For many households, this is a tangible benefit. It could cover a utility bill, a week's groceries, or a car insurance payment. It provides a slight increase in monthly affordability. However, this calculation must be viewed with crucial context. First, while $52 is meaningful, it is a marginal improvement in the face of still high home prices and overall borrowing costs. Second, it's vital to compare this to the recent past. During the peak of the low-rate environment, mortgages were available below 3%. The payment on that same $336,000 loan at 3% would be roughly $1,416, a staggering $770 less per month than even the new, lower rate. This comparison underscores that while the Fed's cut offers relief, it does not represent a return to the unprecedented affordability of the past decade. The market is experiencing a cautious thaw, not a sudden spring. The real question for buyers is whether this incremental saving, combined with other market factors, is enough to justify their entry into the market. This decision depends less on the Fed's single action and more on personal financial readiness and long-term plans, highlighting that the power of this rate cut is ultimately psychological as much as it is financial. With the specific savings numbers calculated, the next crucial question is, does this move by the Fed have enough power to activate the market, or does it merely remain at the level of drawing attention? To answer this, we need to look at actual market health indicators from the most reliable data sources. According to the latest report from the Redfin data center, we have seen a significant increase in traffic to home listings and scheduled home tours over the past week. This metric, often referred to as buyer traffic, indicates that interest has been rekindled. Many potential buyers, who had been patiently waiting on the sidelines, are now beginning to take their first steps to re-explore opportunities. However, this enthusiasm has not yet fully translated into immediate purchasing action. Data from the National Association of Realtors, NAR, shows that the pace of sales has not experienced a strong breakthrough. The average number of days a property remains on the market has only decreased slightly, and the final sale-to-list price ratio still does not show a significant increase in competitive pressure. This indicates that buyers are still in a state of exploration and caution. They are enjoying having more choices and less competition in bidding wars compared to a year ago, but they are not rushing to put down money. This caution stems from two main factors. First, although interest rates have fallen, home prices remain high due to the persistent limited supply caused by the lock-in effect. Second, buyer sentiment remains wary of an economy with many fluctuations and the potential for further interest rate volatility. They want to be sure that this is truly the beginning of a sustained downward trend and not just a minor dip in an overall still volatile trend. Thus, the data shows a market resembling a gigantic machine, slowly restarting after a pause. The traffic lights have turned from red to yellow but are not yet fully green. The increase in interest is a positive signal, but it needs to be followed by a steady increase in successfully closed transactions in the coming weeks to truly confirm a new trend. The current momentum is promising but still too fragile to be declared a definitive market turnaround. All eyes will be on the next few rounds of data to see if this initial spark of interest can ignite a sustained recovery. So where does this leave us? After dissecting the Fed's move, the tangible savings, and the market's tentative response, the overarching conclusion is clear. The market is experiencing a gradual thaw, not a dramatic explosion. The rate cut is a significant psychological turning point, but its practical power to radically transform affordability remains limited in the immediate term. Looking ahead, the forecast hinges on two critical variables. First, the persistence of the lock-in effect. With millions of homeowners still enjoying mortgages below 4%, the structural shortage of existing homes for sale will continue to be the dominant force propping up prices. This inventory crisis won't be solved by a single rate cut. It requires a sustained period of lower rates to incentivize homeowners to finally relinquish their golden handcuffs and list their properties. Second, the market's trajectory is utterly dependent on the Fed's next moves. This initial cut is best viewed not as a singular event, but as the potential start of a full easing cycle. The real catalyst for a more dynamic market shift will be a sequence of subsequent cuts throughout the year, which could gradually pull mortgage rates down toward the 6% threshold or lower. This would unlock a much larger wave of pent-up demand and could finally begin to normalize inventory levels. For builders, this environment solidifies the imperative to focus on attainability. The era of building ever larger, luxury-focused homes is giving way to a necessity for innovation in constructing smaller, more efficient, and cost-effective housing solutions to meet the market where its purchasing power truly is. The bottom line for buyers and sellers: patience and preparation are paramount. If you are a buyer, this cut offers a slight improvement, but the market remains competitive. Use this time to strengthen your financial position, improve your credit score, solidify your budget, and get pre-approved. If you are a seller, realistic pricing is still essential. While you may see more traffic, buyers remain highly sensitive to value. The greatest power of this Fed cut is its signal. It marks a shift in momentum and offers a glimpse of a more balanced market on the horizon. But for now, navigate with cautious optimism, armed with data and realistic expectations. The recovery is underway, but it will be measured in months, not days. We've analyzed the numbers, the data, and the trends together. But now, I want to hear from you. What are your thoughts on the Fed's decision? Does it make you more confident to enter the market, or will you continue to wait and observe? Is now the right time to buy a first home or to invest? Please share your perspectives and questions in the comment section below. I will read and respond to the most valuable discussions. To ensure you don't miss the most updated and in-depth analysis on all upcoming changes in the U.S. real estate market, please hit the subscribe button and the bell icon right below this video. Every subscription from you is my motivation to continue creating valuable content like this. If you found this video helpful, please share it with a friend or family member who might also be interested in the housing market. Thank you so much for watching. I'm Smart Property USA, and I look forward to seeing you in the next video.